You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
Welcome to the Deep Dive. Today we're digging into something really fundamental for anyone thinking about their money. Should you be saving or should you be investing?
Yeah, it's a question we hear all the time. And really, the main thing we want you to take away today is that it's not one or the other.
Right.
You actually need both. They work together. Think of them like, essential tools in your financial kit.
Exactly. We're going to explore why saving and investing aren't really competitors. They're actually partners. Two strategies that, when you use them right, are the best way to build wealth and get that financial security we all want.
Absolutely. And look, it doesn't matter where you are in your financial journey. Maybe you're just starting out trying to figure things out.
Or maybe further along thinking about retirement.
Right, or managing investments already. The core ideas here, they apply to everyone because really it's about building a solid financial future.
Okay, so to really get a handle on this, let's talk about what we're calling the Great Misunderstanding. We've got this story, Sarah and David.
Ah, yes, Sarah and David.
Both pretty disciplined, right? They decide, okay, $500 a month, let's put it aside. They do this for 3 years. Sarah, she's a bit more cautious, puts her money in a regular savings account.
Standard stuff.
Yeah. After 3 years, she saved $18,000, which is great. But the kind of deflating part, it's only grown to maybe $18,200.
Oof, barely anything.
Exactly.
Yeah.
She did the hard work, the discipline was there, but the growth, almost nothing. Feels like running in place.
Now, David, same deal. $500 a month.
Yeah.
But he invests it, puts it in a, let's say, diversified portfolio.
Okay, so like stocks and bonds, that kind of mix.
Exactly. Spreading the money around. Stocks give you a piece of a company. Bonds are like loans you make.
Yeah.
So over those same 3 years, his account, it definitely bounced around. That's investing for you.
Ups and downs.
Right. But at the end of the 3 years, that $18,000 he put in, it's grown to maybe $22,000, noticeably more.
Okay, so David's ahead in terms of growth. But here's the twist, right?
Uh-huh.
Sarah, she's missing out on that potential long-term growth. But David, he's got this big vulnerability. He doesn't really have an emergency fund.
That's the key.
One bad break job loss, big medical bill, and suddenly he might have to sell those investments, maybe at a bad time, taking a loss just when he needs cash.
And that story, it just perfectly highlights the main point.
Yeah.
Saving, investing, they're different tools, for different but equally important jobs.
They complete the picture, not compete.
Exactly. Not competing, completing. Well said.
Okay, so let's get really clear on the terms, because people throw saving and investing around pretty casually. What do we mean by saving?
Right. So saving, we're talking about putting money aside in places that are very low risk and critically easy to get to. Like
Right.
your basic savings account, maybe a high yield savings account if you can find one, money market accounts, maybe CDs, certificates of deposit. The main things are easy access, low risk.
Got it. And the goals there?
Two main goals, really. One, capital preservation. Keep your money safe. Don't lose the principal amount.
Makes sense.
And two, liquidity. That just means you can get your hands on the cash quickly when you need it. No fuss, no delay.
Okay, now investing. That's
Different.
a different animal, yeah.
Yeah.
Investing is putting money into assets hoping they'll grow over time. So things like stocks,
Owning pieces of companies.
right, bonds, which are essentially loans, mutual funds where lots of people pool money.
Diversification baked in.
Exactly. ETFs, exchange-traded funds, similar, but they trade like stocks or even real estate. The expectation here is you'll get a return, your money will grow.
And the main goal there is.
Capital appreciation, growing your wealth over the long haul. But, and this is crucial, the potential for more growth comes with risk.
The risk of losing money, especially short term.
Precisely. The value can go up, but it can also go down. You have to be okay with that fluctuation.
So boiling it down, savings, low potential return, short-term focus, safety net.
Yep. Foundation stability.
Investing, higher potential return, long-term focus, growth engine, but riskier day-to-day. You got it. And that analogy you used earlier is perfect. Savings are the foundation of your financial house. Essential, solid, but maybe not flashy.
Right.
Investments. That's the structure you build on top. That's where the value grows. But like any house, that structure needs the solid foundation. It can't stand without it.
Okay, let's really make the case for saving then. Because sometimes, especially when markets are hot, it feels like everyone's just talking about investing returns.
Yeah.
Why is savings still so vital?
Well, like we saw with David, the absolute number one reason is liquidity for emergencies. It's non-negotiable.
Life happens.
Life definitely happens. Your car dies. Unexpected medical stuff pops up. Maybe, worst case, you lose your job. In those moments, you need cash. Now.
And trying to sell stocks quickly? Not ideal.
Not ideal at all. You might have to sell at a loss or it just takes too long. You can't pay the tow truck driver with stock certificates, right?
No. So there's a rule of thumb for how much to save for emergencies.
Yeah. The standard advice is to aim for an emergency fund covering 3 to 6 months of your essential living expenses.
Essential expenses. Okay. So if your basics, rent, food, utilities, transport costs, say $4,000 a month.
Then your target is somewhere between $12,000 and $24,000.
Okay. Now, I can hear some people thinking, wow, that's a lot of money just sitting there not really growing.
I know, it feels like that sometimes, like it's idle money or even dead money.
Right.
But you absolutely have to reframe that. That money isn't idle, it's working. Its job is to provide security, peace of mind. It's your financial safety net.
It's buying you stability.
Exactly. It's insurance for your financial life. It's working hard just by being there, ready.
Okay, beyond those big unexpected emergencies, when else is saving the right move?
Definitely for any goals you have in the short term. Let's say anything within the next maybe 2 to 3 years.
Like a house down payment.
Perfect example. You know you need that money in, say, 18 months. You absolutely do not want that in the stock market. Market goes down right before you buy. Disaster.
Okay, or big vacation next year.
Yep. Saving goal. Starting a business soon. Need initial operating cash. Savings. Anything predictable and relatively close.
I've also heard savings referred to as opportunity money. What's that about?
That's a great concept. It means having cash ready to jump on unexpected opportunities.
Like?
Maybe a chance to invest in a friend's promising startup comes along. Or maybe the stock market takes a big dip and you see a chance to buy good long-term investments cheaper.
So you can buy low without messing up your existing plans.
Exactly. You can seize the moment without having to sell your long-term holdings or, worse, go into debt. It gives you flexibility.
And there's a huge psychological piece too, isn't there? Just knowing you have that cushion.
Oh, absolutely. The peace of mind is massive. It cuts down so much financial stress. And interestingly, it can make you a better investor.
How so?
Because when you're not terrified about needing that investment money tomorrow for an emergency, you're way less likely to panic sell when the market gets choppy.
You can stick to the plan.
Right. You can ride out the volatility because your short-term needs are covered by savings. You make calmer, more rational investment decisions.
That makes complete sense. It's a buffer for clear thinking.
Totally. Just think back to, say, early 2020. The pandemic uncertainty.
Yeah, scary times financially for many.
People who had solid emergency funds, they could weather job losses, reduced income without freaking out. They didn't have to sell investments when the market tanked.
But those without savings?
They were often forced to sell right at the bottom, locking in huge losses, missing the recovery that came later. It was a brutal lesson in the value of that savings foundation.
Okay, so saving is absolutely foundational, bedrock stuff. But it's not the whole story for building wealth long term, right? What are its limits?
This is where saving alone falls short. The biggest enemy of the long-term saver is inflation.
The silent thief, yes.
Exactly. Inflation just means the cost of everything, goods, services gradually goes up over time. Your dollar today buys more than your dollar will next year.
And historically, inflation isn't trivial.
Not at all. Over the last 50 years in the U.S., average annual inflation has been around, 3.8%? Now compare that to interest rates on typical savings accounts.
Often way below that, sometimes less than 1%, especially recently.
Precisely. And that gap, that's the problem. Your savings might earn a tiny bit of interest, but if inflation is higher, you're actually losing ground.
Losing purchasing power.
Mm-hmm.
Your money buys less even though the number looks slightly bigger.
You got it. Let's run a quick number. Say you have $10,000. Savings account pays 1%. Inflation is 3%. After a year, you have $10,100.
Okay.
But because prices went up 3%, that $10,100 buys less than your original $10,000 did. You've technically gained $100, but you've lost real value.
Like running up an escalator that's going down fast.
It's a perfect analogy, and over longer periods, that effect is brutal.
It compounds, but in the wrong direction.
Yeah, it really does. Take that $10,000 at 1% for 30 years. It grows to about $13,500.
Okay.
But if inflation averaged 3% over those 30 years, you'd need around $24,000 just to buy the same amount of stuff your $10,000 bought initially.
Wow. So you've lost over 40% of your purchasing power.
Roughly, yeah. Your money looks like it grew a bit, but its real value has tanked. This is why people say, over the long term, not investing is actually the riskier move.
Because you're almost guaranteed to lose value to inflation if you just save.
Exactly. The erosion is slow, but it's relentless.
Okay, so that sets up the case for investing perfectly. Savings protect you short term, but investing is where the real long-term growth potential lies, especially beating inflation.
Absolutely. Investing is about building future wealth, growing your capital. Historically, let's take the stock market as an example. The long-term average annual return has been around 10%.
Okay, 10% nominal return.
Right. Now, factor in that, say, 3-4% average inflation, you're still left with a real return growth above inflation of maybe 6-7% per year, on average, over the long haul.
And that difference between, say, 1% in savings and 7% real return from investing over decades.
It's enormous, transformative. The power of compounding at that higher rate is just incredible.
Let's go back to Sarah and David. Fast forward 30 years. Same $500 a month discipline. What does it look like?
Okay, so Sarah, saving diligently at 1% for 30 years, her $180,000 total contribution grows to about $209,000.
Okay, better than nothing, but...
Right. Now, David, investing that $500 a month, if we assume he gets that historical average of, say, 7% annual return, and remember, that's not guaranteed, it fluctuates.
Sure, average over time.
His $180,000 contribution would grow to roughly $612,000.
Wow, nearly 3 times as much.
Almost triple. Just from harnessing the growth potential of investing over that long period, it shows the massive opportunity cost Sarah paid by only saving.
That really drives the point home. And it means investing isn't just for retirement way down the line, is it?
Not at all. Think about other big goals. Maybe you want a bigger house in 10 years, funding kids' college educations. These things need significant capital. Investing gives you a much better shot at reaching those bigger numbers over those kinds of time frames.
Especially if you start early.
Oh, starting early is huge. That longer compounding runway makes such a difference.
And investing can offer other benefits too, right? Like income.
Yeah, definitely. As your portfolio grows, you can start getting income from it. Dividends from stocks.
Companies sharing profits.
Right. And interest payments from bonds. Over time, for some people, that investment income can grow enough to cover a chunk, or maybe even all, of their living costs.
That's the dream of financial independence, basically.
That's the core idea, yeah. Your money starts working for you, generating income.
And you mentioned investing helps fight inflation. How does that work practically?
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
Well, think about it. Companies whose stocks you might own can often raise their prices when their costs go up due to inflation. That helps support their profits and, potentially, their stock price.
Okay.
Real estate values also tend to rise along with inflation over the long term. And even in the bond world, you can buy specific bonds, like TIPS in the U.S. Treasury, inflation-protected securities designed to adjust their value based on inflation. So investing offers built-in ways to combat that erosion.
Okay, investing sounds powerful. But we have to talk about the risks. It's not a smooth ride up.
Absolutely not. We have to be clear about the risks. The main one is volatility.
The ups and downs.
Exactly. The value of your investments will fluctuate, sometimes a lot. And that means there's potential to lose money, especially if you need it back quickly.
And this is where time horizon becomes absolutely critical again.
Crucial. The longer you plan to stay invested, the less impact those short-term swings tend to have on your overall results.
So 1 year, the market could be up 20%, down 20%. Wild swings.
Totally possible. Even over, say, 5 years, you might still end up with less than you started with. It happens.
But looking longer, 15, 20 years.
Historically, looking at broad market indexes over those longer periods, the odds of ending up with positive returns have been very, very high. Time smooths out the bumps and lets the long-term growth trend take over.
Which brings us back to that guideline. Don't invest money you need soon. Like next 2 or 3 years soon.
That's the golden rule. If you're saving for that house down payment next year, that money should not be in the stock market, period.
Because the market could easily drop 10, 20% right when you need to pull the money out.
Exactly. You could be forced to sell at a loss. And trying to guess when the market will be up or down, market timing, it's a fool's game for most people. Don't even try.
And then there's the risk inside our own heads, our emotions.
Oh, huge risk. Probably the biggest for many individual investors. Fear and greed.
The classic traps.
Yep. Market tanks, fear kicks in, people panic, sell near the bottom. Market soaring, FOMO, fear of missing out, kicks in, people pile in near the top.
Buying high, selling low. The exact opposite of what you want.
It's human nature, but it's terrible for investment returns. We've seen it time and again. People who bailed in 2008 and missed the recovery.
Or piled into tech stocks in late 99.
Exactly. Those emotional decisions can absolutely wreck a good plan. Success often comes down to having a strategy and sticking with it, tuning out the noise, controlling those impulses.
Discipline.
Discipline is key.
Okay, so pulling this all together, it's crystal clear. Not saving or investing. It's saving and investing. The perfect partnership.
That's the core message. They work together beautifully. Each one covers the other's weaknesses, creating a much stronger financial picture overall.
Your savings, the emergency fund, the short-term cash, gives you stability, peace of mind.
Which lets you invest for the long term without panicking. You know you're covered, so you can let those investments ride out the bumps. You're not forced to sell at a bad time.
And meanwhile, the investments are doing the heavy lifting for long-term growth, beating inflation, building real wealth.
While the savings handle the day-to-day security and near-term goals, it's a smart division of labor, each tool doing what it does best.
Back to the house analogy.
Yeah.
Savings. Essential, boring foundation.
Yeah.
Investments. The valuable structure built on top.
You need both. Can't have a strong house on a shaky foundation, and a foundation alone doesn't give you much shelter or value growth.
So, practically speaking, how should someone think about splitting their money between the two? Is there a general framework?
Yeah, while everyone's situation is unique, a good general approach often looks like this. Priority number one, absolutely, is build that emergency fund.
3 to 6 months of essential expenses.
Right. In a safe, easy access place like a high-yield savings account, get that foundation poured first.
Okay, step 1. What's next?
Next, look at your workplace retirement plan, like a 401k. If your employer offers a match,
Free money.
it's literally free money. Make sure you're contributing at least enough to get the full match. That's an instant guaranteed return you don't want to miss. You might even do this while building the emergency fund if possible. It's that valuable.
Good point. Okay, emergency fund built, getting the match. Then what?
Once that emergency fund is solid, then your main focus can really shift to ongoing long-term investing for retirement and other big goals.
While still keeping the emergency fund topped up.
Absolutely. Maintain the emergency fund. And you'll also still be saving separately for any other shorter-term goals you have. Vacation, new car in a couple of years, whatever. It's about managing these different streams.
That seems very logical, step by step. Now, how do we make this actually happen? Practical strategies for the real world.
The number one strategy, automation. Make it effortless.
Set it and forget it.
Pretty much. Take the decision-making and willpower out of it each month. First, set up automatic transfers from your checking to your emergency savings account.
Treat it like a bill.
Exactly. It just happens every payday or every month until you hit your goal. Then maybe you adjust it just for maintenance.
And automate the investing side, too.
Definitely. Your 401k contributions, usually automatic from your paycheck. If you're using an IRA or a taxable brokerage account, set up automatic monthly investments from your bank account.
So the money just moves where it's supposed to go.
Right. It removes the temptation to skip a month or try to time the market or let emotions interfere. It just happens. Consistency is king, and automation builds consistency.
Okay, what about when income goes up? Raises, new job. How do we adjust?
Good question. Ideally, as your income grows, you increase your saving and investing amounts too. Try not to let lifestyle inflation eat up the whole raise.
Aim for a percentage.
A common target people talk about is saving and investing maybe 15–20% of your gross income total. But look, if you're just starting, that might feel impossible.
Don't let perfect be the enemy of good.
Exactly. Start where you can, even if it's 5% or just $50 a month. The key is building the habit. Get the snowball rolling. You can always increase it later as your income grows. Consistency beats amount, especially early on.
I've also heard about this bucket idea for organizing money. Can you explain that?
Yeah, the bucket approach is really helpful mentally. You divide your money into different buckets based on when you'll need it and what it's for.
Okay, like bucket 1.
Bucket 1 is your immediate needs bucket. Emergency fund, money for bills coming up, maybe that vacation next month. This needs to be super safe and liquid, high yield savings, money market, zero risk.
Got it. Bucket 2.
Bucket 2 is for medium-term goals, maybe 3 to 10 years out, new car in 5 years, house down payment in 7. Here, you might take a little more risk for a bit more potential growth, maybe conservative bond funds, balance funds, still pretty safe, but not cash.
Okay. And bucket 3.
Bucket 3 is your long-term powerhouse. Goals 10 plus years away, especially retirement. This is where you can typically afford to take on more market risk for higher potential growth. Stocks, stock funds, ETFs. This is your growth engine.
So it aligns the risk you take with your time horizon for needing the money.
Precisely. It stops you from, say, putting next year's tuition money into volatile stocks. It brings structure to your allocations.
That's a really clear framework.
Yeah.
Okay, let's talk mistakes. What are the common ways people mess this up, the saving-investing balance?
Oh, there are a few common pitfalls. One is definitely keeping too much money in savings, way more than the 3 to 6 month emergency fund plus near-term goals.
Being overly cautious.
Right, it feels safe, but that excess cash is just getting eaten by inflation, missing out on years, maybe decades, of potential growth. Big opportunity cost there.
Yeah, on the flip side.
Investing money you know you'll need soon. Within that, say, 1 3-year window, putting next year's down payment in the market because savings rates are low, huge mistake.
Because you risk it not being there when you need it.
Exactly. Short-term market moves are unpredictable. Don't gamble with money you absolutely need in the near future.
Another big one you mentioned, trying to time the market.
Yeah, waiting for the perfect time to invest or trying to jump in and out based on headlines, it almost never works consistently.
Time in the market beats timing the market.
That's the mantra. Just get invested according to your plan and stay invested. Consistent contributions over time work far better than trying to be a market genius. The best time to start was yesterday. The next best time is today.
And letting emotions rule the day. Fear and greed again.
Still a huge one. Panicking during crashes, getting euphoric during booms, sticking to your long-term plan, ignoring the noise, that's how you win. View volatility as the price you pay for potentially higher long-term returns.
Okay, one more mistake.
Not adjusting your plan as life changes. Your income changes, your goals shift, your family situation evolves. Your financial plan isn't static.
Set it and forget it isn't quite right then.
Automate contributions, yes. But review the plan itself regularly, at least once a year, or after any major life event, marriage, kids, new job. Make sure your saving and investing strategy still fits your life.
Right, keep it aligned. Okay, let's zoom out again. The long view. What's the real power, the ultimate payoff of doing both saving and investing consistently for years?
The long-term impact is profound. It's about building resilience and building wealth. The savings cushion gives you security, stability, the ability to handle shocks without derailing everything.
Peace of mind, rational decisions.
Exactly. And the investments. They harness compound growth. Your money starts making money, which then makes more money. It snowballs over decades. This combination creates a financial life that's both secure and has the potential for significant growth. It lets you reach those big life goals.
Can you paint a picture? Someone starting today, maybe 25, decent first salary, say 40K.
Sure. Let's say they commit to saving and investing 20% consistently. So $8 a year initially, increasing as their income grows. They build the emergency fund, then focus on investing.
Over 30 years, say, until 55.
With reasonable income growth and average market returns, it's absolutely realistic they could have accumulated hundreds of thousands of dollars, maybe 500K, 700Ks, even more depending on returns and contribution increases by their mid-50s. That's the power of starting early and staying consistent.
Wow, that really puts it in perspective. And at some point, the investments start doing a lot of the work themselves.
That's the magic inflection point. Like we said, a $500,000 portfolio averaging 7%. That's throwing off $35,000 a year in returns before you add any more money.
It becomes self-sustaining almost.
It starts to feel that way. The growth from the investments themselves becomes a major contributor, potentially exceeding your own contributions later on. That's how you build towards financial independence, patient, consistent saving and investing over a long time.
And this balance, this approach, it probably needs tweaking as we go through life, right?
Oh, absolutely. Your strategy should evolve. In your 20s, focus is often build the emergency fund, start the investing habit, learn the ropes. Even small amounts matter then for habit formation.
Then 30s and 40s.
Usually peak earning years. You can often afford to be more aggressive with saving and investing rates. Max out retirement accounts. Maybe start taxable investing too. Really build that momentum.
And later, 50s and beyond, maybe approaching retirement.
You might start shifting gradually towards more conservative investments to preserve capital, less focus on maximum growth, more on protecting what you've built, while still keeping enough savings for living expenses. But again, it's personal. Depends on your goals, retirement timeline, risk tolerance.
But the core idea, save for stability, invest for growth that stays constant.
That core principle holds true across all stages. You just adjust the dials based on where you are in life. Flexibility within the core strategy.
Okay, as we wrap this up, this has been incredibly helpful. If there's one single takeaway message you want people to really internalize from this deep dive, what is it?
It's simply this. Don't choose, don't think, should I save or invest? The answer is almost always both. You need both for a healthy financial life.
Saving for security.
Gives you stability, lets you make smart choices, protects you from shock,
Investing for growth.
builds your wealth over time, beats inflation, helps you reach big goals. They're two sides of the same coin. You need the whole coin.
And the best time to put this into action.
Right now, today, wherever you are. No emergency fund. Start one. Even $20 a week. Not investing. Start now. Even a tiny percentage.
Don't wait for the perfect moment.
Absolutely not. Compound growth rewards starting early more than anything else. Even small amounts, started early and consistently, can grow into something substantial over time. Your future self will be incredibly grateful.
It's a personal journey for sure, but these principles are pretty universal.
Totally. Your specific numbers, your exact allocation, that's personal. Tailor it to your goals, your income, your risk comfort. But the fundamental need for both saving and investing, that applies to just about everyone trying to build a better financial future.
So the final thought really is, can you afford not to do both?
That's the real question, isn't it? The decisions you make today about saving and investing are actively shaping what your financial future looks like. Short-term markets are anyone's guess, but long-term. Consistent savers and investors almost always come out ahead.
Well, thank you so much. This has really clarified how saving and investing aren't enemies, but essential partners.
My pleasure. The bottom line for everyone listening, making good, consistent decisions about both saving and investing, over time, that's how you build real financial security and wealth.
So to all of you listening, take that first step today. Stay consistent. Let saving and investing work together for you. If you found this deep dive helpful, please subscribe, share it with someone who might benefit. Until next time, keep making your money matter.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.